Old as a company. We launched the website 6 years ago. Many of the founders worked together at Expedia, so we have our roots in another Seattle tech bellwether, which of course has its roots in the company that we all owe a debt of thanks to, which is Microsoft, which probably none of us would be in this room were it not for Microsoft in some way, shape, or form. So I want to talk to you about the last year and a half at Zillow, because it's been a very exciting and busy and stressful and fun and challenging and exhilarating year and a half. And for us, our IPO was a year ago. It feels kind of funny to use the IPO as sort of the basis for our speech, because to us, the IPO itself was really just a financing event, just like raising a venture round. It certainly wasn't an end in and of itself, and it wasn't even really that big a deal. It was just a way to raise capital. But it serves as a pretty good sort of bookend to this story. So we had a board meeting in December 2010 where I told the board, okay, I thought we were IPO ready, and I'll come back in a moment to why I drew that conclusion. And I said, I think we can get everything ready and be public in a year, by the end of 2011, a year from now. And they said, well, that sounds good, Spencer, but how about 6 months instead of a year? I said, I didn't think that was possible, but we'd give it a shot. We'd try to get out before July 4th, 2011. And the story actually begins a couple years before that, because the way we built Zillow, we always expected that we would be public someday. And this is an important point for entrepreneurs here about your fundraising strategies. And I think a lot of people forget that what fundraising decisions you make really dictate your exits in a lot of ways. So we raised $87 million in venture capital across 3 institutional rounds. That is a lot of venture capital money. When you raise that much money at as high valuations as we did, 100 million post, 260 post, and $300 million plus post, you kind of have to go public, okay? Because you've put so much preference, you've raised so much money from venture capitalists at such a high valuation that unless you can get some huge M&A exit, which in our category, the real estate category, just wasn't going to happen because nobody could afford to buy a company at that type of price, then you have to go public. And the point that I'm making for you as entrepreneurs is a lot of people get caught up in okay, I did my seed round and now I can do an A round and I can do 20 at 100, isn't that great? Or I can do a B round of 30 at 125 or whatever. You get kind of romanced by venture capitalists and by Sand Hill Road, et cetera. And it's great to be able to raise money, but just remember that whoever puts in money at that round wants a return. And for example, if you do a round of 20 and 100, you've just taken any M&A exit under 200 off the table. And as a founder, that may or may not be the best thing for you and for your employees and your team. So really think about how your fundraising strategy could impact the potential exit. So anyway, we always knew that we would be on an IPO path at some point, and so we structured the company from an organizational standpoint, from an operational standpoint, from a finance and legal standpoint to go down that road. So for example, for a couple years before we were public, we were producing quarterly financial memos, we were doing internal budgeting and forecasting. We were basically acting like a public company even though we were still private. And we were also meeting with investors, and such that when we eventually had our roadshow for the IPO, of the 100 or so financial institutions that we met during that couple-week process around the country, I or our CFO or our chairman had met with at least 3/4 of them several times over the prior couple of years, and having that relationship with them going into this new relationship where they became our shareholders was definitely helpful. So what does it mean to be IPO ready? Well, there are 5 things that I think a company needs to be IPO ready. The first is some sort of revenue scale. Okay, this may sound kind of obvious, but it's actually not. And so the general rule of thumb has been $100 million annual run rate before your IPO ready. We were at, I think, around 15 million in a trailing quarter, so 60 million revenue run rate. Bill Gurley, who's one of our VCs from Benchmark Capital, he's blogged on his blog Above the Crowd a lot about how he thinks $40 million annual run rate, around $10 million a quarter, is a pretty good bogey. So anyway, somewhere between $10 million a quarter and $25 million a quarter in revenue is what you need to be IPO worthy. The second thing is to be profitable. And again, on some level you might say, well, duh, but actually, no, a lot of companies are not profitable, and some of them try to get public, and some of them succeed. But being profitable on either an EBITDA or net income basis, in particular in this new IPO climate where so many growth companies have disappointed in the first couple quarters after being public, is really, really important. So we do for profitable, and that was one thing that I was waiting for before I could tell the board that I thought we were IPO ready. The third is the ability to forecast well, actually, let me save that one. So the third is kind of an easy one, which is just financial controls. So you don't have to be Sarbanes-Oxley compliant when you go public. You have a couple of years to do that, but you have to have good enough financial controls in place that there's at least some sort of a path to being SOX compliant. A lot of the stuff that SOX requires is just good business management as well. Things like making sure that you've got good internal controls, making sure that nobody can steal all your money and run off with it, and making sure that you have proper accounting for things. The fourth and fifth are the areas where I think most people get tripped up because companies are so overqualified on the first couple, in particular revenue, that they forget about the fourth and fifth. And for me, this is an ability to forecast your own results, an ability to have a really good sense of your of the levers of your business. Okay, so what I mean by understanding the levers of your business is you have to be at the place where your company is mature enough that you know if I do X, then Y will happen. If I hire 20 more inside salespeople, then this is what will happen to our revenue. If I hire 5 more developers, this is what will happen to the product. This is what will happen to traffic. If I press this button, then this next thing will happen. The cause and effect within your business. And so, for example, at Zillow, for the first couple of years, we were still experimenting so wildly across different aspects of the business, changing the types of ad models, changing the ways that we interact with consumers, changing the sales channels from a primarily self-serve sales channel to an inside sales channel now, where we have over 100 inside salespeople, that we didn't really have a good handle on the levers of our business until about 2 years or so ago. I'll cite an example here, two companies that I think are interesting examples when you think about being able to understand the levers of your business and be able to forecast your results. One of them, Groupon, which is an incredibly successful company, obviously by all measures. But one of the things that they've had a challenge with in the first couple of quarters after going public is being able to forecast their own results because, like any young company, they're still experimenting in their business model. Okay? They're moving into higher-end Groupons. And 2 quarters ago, their first quarter post-IPO, they actually had to restate their financial results. Why? Well, not because of any accounting shenanigans or anything, any sketchiness. It was simply that as they started selling more high-end Groupons, the cancel rates and the assumptions that they had around cancel rates for their Groupons turned out to be flawed. It turns out that when you sell a $1,000, skydiving trip, people are more likely to cancel when they break up with their girlfriend and they have no one to go skydiving with anymore. They cancel. But if it's a $20 coupon in a burrito store and you have no one to get a burrito with, you just that's breakage and you don't bother canceling it. So they were using the low-end Groupon cancel rates and applying that to these new high-end Groupons, and as a result, their revenue recognition, their accrual models for how to recognize the higher-end coupons were dramatically incorrect, and they had to restate revenue. So this is an example. The company was doing everything right in terms of experimenting with their business, moving in new directions, but it shows one of the perils of going public when you're still learning what the levers of your business are. The other one, of course, is Facebook, which is being challenged by this migration to mobile. So I think more than half of Facebook's usage is now on mobile. I could be wrong about that. If not yet, then certainly sometime soon. More than half of Zillow's usage is now on mobile, as measured by how many homes are viewed on mobile rather than the web. But until a couple weeks ago, Facebook had never run any ads on mobile whatsoever. None. And so it's going to take a while, of course, for them to experiment with what the right ad units are, to figure out how to sell it to advertisers, to figure out how to report back the efficacy of these mobile ads to advertisers. And they'll figure all that out, but it's going to, there'll be some starts and stops along the way. And one of the reasons that they've had a bit of a rocky start has been because they're now learning all that, understanding the levers of their business as they shift to mobile under the scrutiny and the glare of being a public company. So we wanted to wait until we had a good enough understanding of the levers of the business, and therefore we were able to forecast effectively. And those are the fourth and fifth requirements that I think are really important in order to be able to go public. So we had a bake-off. That's what you call when you start meeting with investment banks in January of 2011. We met with 6 or 7 different investment banks. What we were looking for when we were choosing investment bankers, and I am a former investment banker, I should preface this by saying, is we're looking for, first and foremost, culture fit. Because you're going to spend a lot of time with these people over a year or two. And so just like hiring any employee, you want to make sure you get along with these people. Secondly, we were looking for somebody who understood the business and cared passionately about it, because you're basically hiring a spokesperson. Those bankers and then their whole sales team will go and promote your company through their sales channel to the buy side, as it's known, which are the institutional investors, the mutual funds, or the hedge funds. And so you want to hire a bank that thinks you are bee's knees, that your company is just so awesome, and that they're well able to articulate why, that they're good spokespeople, just like hiring a PR firm is basically what they are. It's a PR firm to where the constituency is Wall Street instead of the constituency being the media. So we ended up choosing Citigroup, who did a fantastic job for us as our book runner. And you enter then what's known as the drafting process. The drafting process is when the lawyers and the accountants and the bankers and a cast of about 60 people get in a room and start writing what's known as an S1, which is a 200-page legal document. And this is a 3 to 6 week process initially, and then you submit it to the SEC, and you go back and forth with the SEC over potentially a couple months or longer. What I learned from that process is that the S1 is really a marketing document, not a legal document. So yeah, it's on file with the SEC, and in theory it's authored by lawyers, but it's read by investors who are trying to decide whether or not to buy shares in the company. And as I now read other companies' S1s, you can quite readily see which which S1s had the drafting led by the lawyers versus which ones had the drafting led by the marketers. So Amy Lutinsky, who's over there, who's our CMO, she was most, as likely to be at the computer, projected at Perkins Coie's offices around the corner with the 50 or so people working on it, where she's driving and she was leading the red lines, the edits on the S1, as our GC was. And the company keeping control of the process and keeping an eye towards the fact that you're selling something, rather than letting lawyers drive the process, all due respect to the lawyers in the room, that's an important differentiation among S1s. And then, of course, once you've got it down to a couple hundred pages on file with the SEC, you have to try to distill the story into about 22 minutes for a roadshow presentation, which is yet a harder communications challenge, because it's hard enough to take 6 years of blood, sweat, and tears and put it into a 100-page or 200-page document. Now you've got to try to distill it into 15 slides. And there, figuring out what's important about your business is even harder, because you have to be so succinct. For me, it was a great process, actually. I learned a lot about our own company and thinking through what's important. The fact that we're investing so heavily in mobile, the fact that we're investing in rentals, how the network effect reinforces itself as more consumers attract more agents who attract more consumers. I mean, the fact that we've got this living database of homes, which is constantly being updated by our community of users. These are messages that come through in the S1 and came through in the roadshow presentation, and now come through in our investor relations messaging, all of which the IPO process helped us crystallize and articulate. So then, once the SEC gives you the green light, then you can start a roadshow, and that's a 2 or 3 week process where the CEO and the CFO travel around the country and meet in usually back-to-back meetings from 7 in the morning to 7 at night, usually across 2 to 3 cities in a given day, and are meeting with mutual funds and hedge funds who are asking questions about the business. Most CEOs dread that process because it's very repetitive and mundane and exhausting. I loved it. I thought it was great. The only thing I like talking more about than my kids is my company. And so for me, to be able to travel around the country and talk to hundreds of the smartest, most successful investors in the country who see technology companies all day long, who meet with our counterparts at all these other companies all the time, and hear their feedback about what they think, hear them replay back to us our story and say, well, have you noticed that, like, just for example, yesterday, I was meeting with an investor. Yesterday, what's that? Is it Thursday? Anyway, recently, I think it was yesterday, I was at an investor conference 2 days ago, and we were talking about churn, which is a common question, is how many of our subscribing Premier agents churn? How many of them leave the program? And they said, well, Rackspace is a company who's also a SaaS freemium model, and the way they talk about churn is X. They look at the same-store sales number on a quarter-to-quarter basis. And anyway, he gave me a little tutorial on how Rackspace looks at their business, and caused me to actually change the way I think about our subscribing Premier agents relative to our installed base. So anyway, very interesting to talk with these investors and get their perspective on our business. Eventually, at the end of the 2 or 3 week roadshow, you get towards pricing. What happens is the book, as it's called, is built over that couple-week period. In our case, we were selling 4 million shares, and there was demand for over 100 million shares, so it was very, very oversubscribed, as it's known. We started at $12 to $14 price range. We raised it to 14 to 16. And then, of course, at the 11th hour, you're trying to say, okay, where do we price it? We price it at 16, 17, 18, 30, etc. And this is where companies sometimes get beaten up for leaving too much money on the table, and there's this huge pop. And then companies also get beaten up for pushing price, and then the stock goes down. And it's a very, very opaque process. You have no idea before you price actually what's going to happen to the stock. And it's a very awkward, weird three-way negotiation between the company, the investment bankers, and the buy side. And the investment bankers are, by definition, conflicted because their real clients are, of course, the buy side. Right? They make more revenue from Fidelity and T. Rowe Price and Vanguard trading through their trading desk than the issuer or the company will ever give them in the fees from the IPO. So they're kind of, it's sort of like a real estate agent who's double-siding the transaction when they represent buyer and seller. They're conflicted, and so seller, or the one selling shares, has to look out for their own interests. So eventually, after much back and forth, and being told, well, these investors, they love the stock at 19, they like it at 20, 21, they start to get a little nervous at 22, they think that's too high. And you're like, well, obviously they're going to say that, right? They want us to sell it at as low price as possible, so that's great feedback, but take it with a grain of salt. We eventually decided to price at 20, and we ended up closing about 35, 36 the first day. You can argue we left too much money on the table because, well, look at that big pop. We sold 4 million shares, so if we had priced it at 30, for example, we would have raised a lot more money or incurred a lot less dilution. I would argue that it was a relatively small offering, only 4 million shares, and you're creating your new shareholder base, and so you want to start off that relationship with your new overlords on a good note where they actually make some money. It's really hard to start a relationship with your new shareholders where they're down by 10 or 20 or 30%. Then you have to work back over several quarters to regain their trust and make amends. Let's see. So what was I was most worried about going into the process was firstly the impact on employees. How do we make sure that we all stay focused and take a moment to celebrate the IPO because it is a milestone. The employees here at Zillow should be proud and are proud of what we accomplished. But it's this very weird kind of, okay, clink a champagne glass and high five and now get back to work. And I actually think Facebook really set the right tone in this regard. The way they had a hack night or hack week right before the IPO, and just the general cultural vibe that they set around just keep shipping and the IPO whatever, it's just a thing, it's abstract and don't worry about it. And we took kind of the same attitude here, where a moment of celebration. And I think employees generally kind of stick their chest out a little more. They probably walk a little taller as a result of us having achieved a successful IPO and being one of only 2 tech IPOs in the last 2 years that haven't traded below their IPO price. But it's also we kind of keep taking it in stride. Also I was worried about could we maintain a transparent culture once we were public. Was a big concern because, like most startups, we had a very, every employee knew how we did every quarter and what our cash balance was, and we were very open about our results. We can't be quite as open about our results now, but what I've learned over the last year or two of kind of tightening up the flow of information is that employees really care about where the company is going, like what's the direction of the company and why am I here. They don't actually really care about, what's our working capital balance, what's going to be our EBITDA for the month. And, they care about what's the strategy and the vision and the mission and why should I go to work in the morning? And you can still absolutely continue communicating all that. In fact, you can communicate even more easily once you're public because you're already communicating all that to investors. And so I don't know if any of my colleagues here disagree, but I don't think being public has changed the culture of transparency and the general culture of kind of how we run the company on a day-to-day or week-to-week basis. The other lessons from the process I'd say were, if you know you're going to go public at some point, you can't start early enough. For us, it was really helpful that 2 or 3 years before being public, we started acting and talking and kind of operating the business like a pseudo-public company. The whole IPO process is basically storytelling, and that's what investor relations is now. It's being able to communicate, as I say, the reason that our CMO kind of has a lot of involvement in the IR process is because it is storytelling just to a different constituency. And yeah, you focus on different things, but just like when you're talking with the media, focusing on particular aspects of the company, here, when you're talking to investors, it's about repetition and storytelling. Being public is not that hard. You know, it's kind of like I went to Harvard as an undergrad, and the joke about Harvard, which I wholeheartedly agree with, is the hardest part is getting in. And once you're there, it's actually not that hard. And that's kind of like being public. Like the hard part is kind of getting public, getting the company to the stage where you can be public. Once you're public, as long as the results are good, it's not that hard. And the fact of the matter is, if the results are bad, it sucks whether you're public or private. It kind of doesn't matter. So all this kind of, you see negativity in the media or among entrepreneurs, like, oh, I don't want to be public, so it's obviously it's so hard, or it's so expensive to get public or whatever. And I haven't had that experience so far here at Zillow. The last thing I'll comment on is the Jobs Act, because basically everything I just said has sort of been thrown out the window by a little piece of legislation called the Jobs Act, which kind of quietly passed about 6 months ago. And the Jobs Act allows companies to file an S-1 with the SEC confidentially. And there are apparently over 50 companies that are now on file with the SEC to go public, and we don't know who they are. What it does is it allows the company to go back and forth with the SEC through that comment period, and then only 21 days before the roadshow, publish and reveal to potential investors the particulars of the S-1. There are a number of other changes under the Jobs Act as well, including companies that file under the Jobs Act only have to show their top 2 employees in terms of compensation instead of top 5. They don't have to provide a compensation discussion analysis section, so they don't have to explain why they pay their executives what they do. They don't have to switch audit partners every 6 years. We have to switch our audit partner every 5 or 6 years, I forget which. Companies that go public under the Jobs Act don't. It's very disruptive to a finance organization to switch your audit partner, your external auditors, and we have to go through it because we went public before the Jobs Act passed. But see, equity analysts can publish research on the day of the IPO instead of after a 40-day waiting period. So anyway, there are a lot of these other changes that they made to the IPO process, all with an eye towards trying to make it easier to get public. And my personal opinion is that there are a lot of aspects of the Jobs Act that are actually pretty troublesome to investors and to companies. And the most important one is that the S-1 isn't public until 3 weeks before the roadshow. So for us, for example, the fact that our S-1 was on file for 6 months before we went public, that gave investors time to do market research, to call our advertisers, to use the product, to use competitors' product, to develop a point of view about the company and our strengths and weaknesses. If investors only have 3 weeks before the roadshow starts to read anything about the company, see their financials, etc., they're not going to do nearly the amount of primary research that they would otherwise do under the old model. And so I think it's pretty problematic. We'll see. No company has actually gone public yet under the Jobs Act. They've just allegedly filed. So we'll see what happens. Anyway, so that's been our story. We've been public for a little over a year. So far, so good. I haven't jinxed anything by my remarks today. And I will open it up for questions if you have any.